Hey guys, I hope you and your families are doing well. You see these three Japanese candlesticks on your screen right now. These are what I call shakeout demand tails. Now shakeout demand tails can be golden and lead to very good trading opportunities if used in the correct context and on the correct stock. So that's what I'm going to do in this video by showing you present day examples, but also charts from the 1960s, because what I'm teaching you in this video is timeless. You can look at stock charts from 100 years ago, the 1930s, the 1940s, 50s, 60s, 70s, 80s, 90s. It's exactly the same thing. Nothing has changed. The principles, the philosophy, nothing has changed with what I'm teaching you here from a trade identification standpoint, controlling the risk standpoint, risk mitigation, and optimizing the profits. So to do that, I'm going to take you through present day and historical examples. These are the ones we're going to be going through. We're going to be going through Broadcom from 2024, Affirm from 2023, Eli Lilly from 2024. Then we're going to go back in time, Coca-Cola from the 1960s, Gatex from the 1970s, and I'm going to be showing you these historical examples just so you can really start to familiarize yourself with the pattern recognition for specifically what is it that you are looking for, how is it you are looking to trade these shakeout demand tail setups. So I really hope you're going to enjoy this video. MarketSmith are today's video sponsor. There is a discounted trial available in the comments below if you are interested. So at the start of the video, it's important that you have the data on shakeout demand tails. So I'm going to take you through the data from Thomas Bosquosi's book, Encyclopedia of Candlestick Charts, and then I'm going to give you a high-level overview of what you're looking for from an identification standpoint, controlling risk, risk mitigation, and optimizing profits. So this is 3 slides from my new 150-page slide deck that's available to members on my platform, all about shakeout demand tails and how I go about trading them. So hammer candlesticks, doji dragonflies, and Takuri lines make up what I call shakeout demand tails. So Thomas Bosquosi in his book Encyclopedia of Candlestick Charts tested 4.7 million Japanese candlestick combinations. So what we can see here is we've got 20,000 database inputs for hammers, doji dragonflies, and Takuri lines. You can see the reversal rate, 60%, 50%, and 66%. Guess what? It's not 100%. Okay, when you identify one of these, you're not going to be right 100% of the time. This is why risk management is very important, that we'll talk about when we come onto the chart examples. But these are the candlesticks here that you're trying to dial in your pattern recognition to go shake out demand tail. Now we want to take it a step further, because it's not just I identified a hammer candlestick, I identified a doji dragonfly. It's where did you see it on the chart? The context is very important, and then what type of stock did you see it in as well? Okay, what type of stock? And I'll be talking about this as we go through. So where to look for shakeout demand tails? Within the context of common chart patterns that are in uptrend and ideally near one or more key moving average. I'll tell you what one or more key moving averages are on the next slide. Now you'll be familiar probably with common chart patterns, flags, triangles, pennants, cup with handles, wedges, channels, flat bases, Davis boxes, all of that good stuff. Now it's important to note here, when you're looking to trade shakeout demand tails, the textbook breakout point often is not, sorry, I read that wrong, didn't I? The textbook breakout point is often not the entry point with shakeout demand tails. That's my dyslexia. I struggle with reading sometimes. The next slide's going to be a little bit text heavy, so we'll see how I get on there, right? But oftentimes the shakeout demand tail is not here. Okay, it's not actually occurring at the breakout point, it's occurring lower in the base, because this is much more buying in line with the institutions who create the lows of the bases. So actually we're trying to identify a leading stock in the market, and then we're trying to look for when it is pulling into certain moving averages, and then we identify a shakeout demand tail. So don't worry, it'll make sense when we go through the 12 examples, but I'm going to read this to you because this will give you a high level overview. Feel free to pause the video, but for me there's 4 parts of every single trade. If you actually break it down and you deconstruct it and you think about a trade, there's only 4 parts really. Number 1, you have the identification. Number 2, you have the controlling risk. Number 3, you have the risk mitigation. Number 4, you have optimizing profits. Okay, so let me just take you through. With shakeout demand tails, this is the high level overview. You're looking for a stock that is in an uptrend above its 200-day SMA and preferably above its 50 SMA too. The stock is building a continuation base and or in a strong uptrend pulling back to a key moving average. Let's talk about these key moving averages while we're here. The key moving averages that I use, there's really 4 of them. It's the 10-day EMA, the 21-day EMA, the 50 SMA, and the 200-day simple period moving average. Now, for these pullbacks and these shakeout demand tails, I'm going to be much more so looking for the first 3, 10-day, 21-day EMAs, and the 50 SMA. The shakeout demand tail forms on one or more key moving average or in proximity. So that proximity point, when we go through the 12 examples, I'll be explaining it, because sometimes you can get it forming just underneath. That's fine. It acts as a shakeout, as the name implies. Shakeout demand tail is designed to shake out weak hands. So we're going to be talking a lot about the psychology of these candlesticks. The relative strength line is ideally in an uptrend. Don't worry, I'll explain the relative strength line when we're on the charts. The relative strength line is hitting the relative strength line 52-week highs pre-base and in the base are bonuses. The stock is either a true market leader, a momentum leader, or a group theme leader. We'll talk about that as we are looking at the stocks. A stock can be in multiple categories. The stronger a shakeout demand tail closes, the better. So the closer the price close is to the high of the range of that shakeout demand tail, the better indication of strength. Ideally, the stock has shown respect for moving averages by finding supportive action near them. Undercuts, shakeouts, and reclaims can be bullish behavior. Ideally, prior earnings reactions have been positive, and the trader thinks the stock is being accumulated by large operators. We're specifically going to talk about this when we look at the Broadcom chart and also the Affirm chart. Entry targeted through the daily high of the shakeout demand tail. Ideally, entry price is as close as possible. That's the identification, high-level overview, controlling the risk. So again, we're trying to create asymmetric risk versus reward trading opportunities. The idea is you're trying to risk a proverbial dollar to make many multiples of that. $3, $5, $10, $15, $20, okay? Big risk multiples. Now, the risk multiple and trying to then optimize the profits, we're going to talk about that in the optimizing profits section. So the controlling the risk, right? The initial stop loss percentage is ideally less than the stock's 20-day average daily range percentage, 20-day ADR percentage. Don't worry, I'll explain that. The initial stop loss percentage can be within 1.5 times the 20-day ADR if less than 4 to 5%. If the initial stop loss is greater than 5%, it must be deemed a very high quality setup in a leading stock that has a history of trending well from this targeted setup. I'm going to explain the character of the stock and how you can assess that when we're going through the 12 examples. Initial stop loss placement, usually a cent below the low, the daily low of the shakeout demand tail. Discretion to place stop loss under key moving averages or round number if appropriate and the risk still makes sense. So sometimes you can just lower the stop loss a little bit, get it underneath a key moving averages, maybe underneath a obvious round number, $20, $50, $100, something like that, okay, but still keeping the risk consent. In terms of the risk mitigation, which I'm not going to talk about too much in this video, I want to keep it much more focused on the first 2 points here, identification and controlling risk. Risk mitigation covered heavily in the blueprint video on the channel. The trader thinks there is a realistic chance the trade can be free rolled within 3 to 5 sessions by achieving initial risk multiple targets 1 to 3 times. Optimizing profits. The stock has a history of being able to successfully break out from continuation bases and trend higher many multiples of the initial planned risk. So this is all about looking back at the chart and assessing, okay, how does the stock break out from this type of setup? How does it trend higher? When it does trend higher, what is realistic to expect before it starts closing below certain moving averages? 10-day, 21-day, 50-day. New IPOs, obviously we don't have that much data, so you're going to have to use your discretion there. The trader should assess the previous character of the stock for which key moving average is best used as a trailing stop. Often it can be a combination. So I'll explain this as we go. This is all about understanding the character of the stock and kind of building a bit of a blueprint with each trade for how am I thinking about managing this trade, okay? So what we're going to do now is I'm going to take you across to TradingView and we're going to start looking at these shakeout demand tail setups. So we're going to begin with Broadcom. So this is going to be the first of 12 examples that we're going to be working through. And I'll point out a couple of key points per slide. Now, Broadcom, I took this trade moving through the high of this shakeout demand tail. So we're going to talk about a couple of key points. And what I want to do first is actually not talk about this shakeout demand tail. I want to talk about what happens pre-base. So what happens pre-base is really, really important. Now, you're probably thinking, well, you're going to talk about shakeout demand tail, so we should be no, we're going to talk about pre-base, because the pre-base action for me is very important. So a lot of this is about trying to follow institutional footprints. Now, Broadcom is a very high price stock. You can see around about $1,000, and you can see it's trading many millions of shares. The 30-day average volume is about 4.5 million shares on this stock. It is a very high dollar volume stock, and a lot of constitutions are playing there. So what I do is I focus on the earnings reactions, okay? Not what the earnings say, the earnings reaction. So how does the market perceive the earnings? How does it react to the earnings? Okay, so the earnings comes out after the close on the 7th of December. So this is the reaction. This rally here is the reaction. What do we see? I call this bullish synchronicity. These are generally widespread candlesticks on a relative basis that open near the low of the bar and close strong. This is an indication of strength. It's an indication of demand, of accumulation. And look at the high relative volume and the persistently high relative volume as well. Interesting. And then this here is my relative strength line. Okay, if you want to find it, go to the indicators here. This is the ADR percentage that I use that we're going to be talking about, and then my relative strength line is here. Okay, this one here, use it, just pin it to the bottom of the chart like that. And what I'm then looking for is a relative strength line that is strong and also hitting 52-week highs. 52-week highs pre-base and in the base, and then post-base as well. Really, really good sign. It means the stock is displaying a lot of leadership. So pre-base, what do we have? We have a very good reaction to the earnings, powerful uptrend, 52-week highs, persistently high volume. To me, I'm thinking, looks like the bigger boys and girls are in there, right? The large operators are in there. Now, as the stock is pulling back into the base, look how the volume dries up. It is persistently and consistently below the 30-bar average, being this black line that you see here, okay? So what is this indicating to me? Well, it's indicating there's a lot of buying on the rally, then there's not too much supply and selling on the pullback. Now, not only is the volume low, the candlesticks generally are tight real bodies. Yes, there are a lot of red candlesticks, but if you look at the real bodies are narrow, and the range of the bar is narrow. So I would associate the narrowness in price, the tightness in price, and the low relative volume, given the context of just pulling back in here, I would just associate that with just absorption of supply. There's not large operators rushing for the exits, because we would see the polar opposite. That's the mental representation that I have in my head for what accumulation looks like and then what absorption of supply looks like. Okay, the stock is just resting here. Now, with a bigger stock like this, Broadcom, the 21-day EMA is going to be more appropriate for. I'm going to show you the next slide is going to be a firm that has a much higher 20-day ADR percentage. I'll explain ADR percentage when we come onto a firm, okay? But the 21-day and 50-day is going to be more appropriate for Broadcom, given the nature of the stock, given the 20-day ADR percentage. So that's where I'm looking for a shakeout demand tail. So with a shakeout demand tail, you see it here. This is it. It's right here. It's like a doji dragonfly. So what I'm doing is I like to use buy stop limit orders primarily. Okay, you can go and maybe I got a video. Oh, it's in the blueprint video on the channel. So buy stop limit order. Okay. So what I'm doing is I'm buying through the high with a buy stop limit order. So again, I'm defining my risk, and then my stop loss invariably is placed a cent below the low. Now with shakeout demand tails, if they occur around key moving averages and the volume, you see the volume here, it's about half the 30-bar average being the black line. That tells me there's not that much supply. Okay, it's a constructive sign if you see low volume on a shakeout demand tail in the correct context. Now what I'm doing is I'm thinking about my initial stop loss. In this instance here, it's about 1.88%. Are you going to get some slippage? You're going to get some slippage. You want to factor that into your calculation. But if we're assuming perfect execution here, 1.88% versus the 20-day ADR percentage of 2.33% is favorable. A 2% stop anyway on the daily chart when you're swing trading is a pretty darn tight stop loss. But what I'm trying to do is keep it in check relative to the 20-day ADR percentage, because not each stock is created equal. Some stocks are quicker, some stocks are slower. So some stocks will have higher stop loss percentages given the nature of the 20-day ADR percentage. Sometimes I'll be much tighter. So I'm letting the stock's own volatility dictate how tight or not my stop loss should be. But anything over 5%, anything that starts with a 5, I gotta think it's a ridiculously good setup. So that's Broadcom there. Okay, so then it's about targeting it through the highs. Okay, I said I'm not going to talk about the risk mitigation and things like that, but I will talk a little bit in terms of the optimizing profits. Okay, when you are taking these setups here, so if you now watch the blueprint video after this video, I think the blueprint video will make a lot of sense for you. That's on the channel, you can search for it. Is when you're taking these shakeout demand tails, again, you've got to have these mental representations in your head. What are you expecting to happen next? Okay, Peak by Anders Ericsson, fantastic book. Building mental representations. So what often happens in my experience when you're targeting shakeout demand tails is 3 things: pop, test, reversal, which in essence is going to look higher high, higher low, higher high. So I build my process, I build my framework around that. So what I'm trying to do is I'm trying to get in here and then trying to free roll the trade, take all of the risk out, that's the risk mitigation, and then I'm trying to sit through the testing action, and then I'm trying to play the stock for a bigger move. That's where the optimizing profits and the sell rules start coming in. So pop, test, reversal, and that's going to be a common theme you see throughout as we go bar by bar on some of these stocks. So let's go on to the next one. Now this is a firm. Now what you'll notice here is the 20-day ADR percentage, so that's the average daily percentage range of the stock over the last 20 days, is 7.42%. It is a lot quicker than Broadcom. This is a very quick stock indeed. When you start getting above 5% and you get 6, 7, 8% territory, you're dealing with some pretty quick stocks. So again, we're thinking about the initial risk relative to the 20-day ADR percentage. Now it's still sub 5%. So okay, it's a relatively tight stop, and it begins with a 4 and the ADR begins with a 7. It's around about 2/3, isn't it? Maybe a little bit less than 2/3. That's okay. It's acceptable. Yes, it's about a 4.5, 5% initial stop, but given the ADR percentage of this stock, it's okay. And if we actually think about, well, what chart pattern is building here? Cut with a handle, okay? Now you'll see the stock is then forming onto the 10-day. So remember, with shakeout demand tails, you're looking for them on one or more key moving averages. Now the three most common ones that I'm looking for is going to be the 10-day, the 21-day, and the 50-day. Okay, so this here, this is a shakeout demand tail, but it is above the 10-day EMA. So if I was to just take a kind of stop loss percentage there and drag it down, you can see if I had been targeting it here, so through the high stop loss, I like to get my initial stop loss underneath a key moving average to the 10-day. So my initial stop loss here, my initial stop loss is going to be around 8.74%, 9%. Now, let's imagine that the 20-day ADR percentage is the same. That's way out of whack, and it's a very high stop loss anyway. It's too great for me. So yes, does the trade kind of work there? Yes, but again, it's the reference point. So these moving averages are a reference point for where you are looking for certain things to happen. I know I'm spending a lot of time on this, but it's important. So the moving averages are a reference point for you to look for, okay, this is where I'm looking for this to happen. So what you're trying to do in your trading is remove variance, remove deviation from your perfect trade. You should know very clearly, okay, what do I think is a 10 out of 10 setup? And then don't deviate from that very much. What I think is an 8 out of 10, a 9 out of 10, and a 10 out of 10 setup, then don't deviate from that very much, okay? If you think about a golfer, if you think about a tennis player serving, the better the player, so the higher quality the player, the less deviation from their ideal routine that you will see. Okay, an amateur golfer isn't going to have a routine. Okay, they're not really going to have a routine, bit haphazard. Okay, step up, yeah, aim over there, yeah, whack it over here. Okay, amateur tennis player, stand there, chuck the ball up, hit it, right? If you think about a professional, there's very little deviation from their routine. That's what you're trying to do with these setups, create a routine. Now, each trade, as I said, really has 4 main aspects: identify, control, mitigate, and optimize. So we're not trying to deviate from that too much. Now, the trade can play out, you're going to have to adapt to new information, but certainly here when we're planning the trade out and everything is kind of slowed down, because I do my work, I do kind of my screening when the market's closed. So things aren't jumping around all over the place, it's just slow as smooth, smooth as fast, slow it all down. Okay, I'm not looking to deviate from what I think are very high quality setups when I'm planning it out. That's why I like to plan my trades out when the market's closed, because I'm not getting kind of shiny object syndrome thinking, well, that's me. No, just take a breath. Slow it down, slow as smooth, smooth as fast. So here, good earnings reaction over here. Then the stock builds a cup and handle. This is a Wyckoff concept of cause and effect. Big causes, this is quite a big cause, this is a multi-week, multi-month base, tend to lead to big effects. Now the 10-day EMA oftentimes is going to be too quick for a lot of stocks, but when you start getting a stock that has a 20-day ADR percentage of 4, 5, 6% and above, the 10-day can be effective. But again, we're looking for the shakeout demand tail. Now in future videos, I'm going to teach you trigger bars and gap down reverse bars in this step. So this here, shakeout demand tail, that's also an inside bar building a flag type pattern on a shorter term basis, and the volume is drying up. See how the volume is just stepping down here, really nice. 52-week highs. Look at this improvement in the relative strength line, really good to see. So again, we're targeting it through the high, stop just underneath the low. We won't talk about the risk mitigation. Okay, and then you're looking to try and ride trends. But we really want to be very specific in terms of what are we doing, okay? What is the system? What is the routine? And not deviating from that. You should know very, very clearly what you think is a ridiculously good setup. and then just try and trade ridiculously good setups. Don't deviate from that too much. Let me take you through one more recent one, which is Eli Lilly. Okay, so Eli Lilly building a very big base, great reaction to the earnings, 52-week highs coming through, and then it builds a very large multi-month base here. Now it starts breaking out of the base, so we have a bit of a confluence here. Okay, it breaks out of the base, pulls back down to test the prior base high. So again, if you're thinking about, this is kind of the breakout point here, right? So again, this is the breakout point. Okay, I'm very rarely actually buying at the breakout point, very rarely actually, but here, pop, test. So now the testing action is not only testing the prior base high, it's testing a key moving average being the 21-day EMA. Now we have confluence. Okay, really important thing. The more kind of things that we can line up in favor for a trade, the better. Okay, but you've really got to know, you've really got to go back, study the stocks, and then decide for yourself, what do you think is a really, really good setup? What do you think is a really good setup? Like, you should know, you should have kind of like a catalog, a playbook, if you like, of, well, I think this is an excellent setup. And you may have like 3 setups, 2 setups, 1 setup, whatever it may be. I have 3, okay? Shakeout demand tails, trigger bars, and gap down reverse bars. And I know what is a 10 out of 10 setup for each of them. And then I just try and stay really close to trading 10 out of 10s. Now, oftentimes it'll be like a 9 out of 10 or an 8 out of 10 as well, but ideally I'm looking to trade 10 out of 10 setups, and that's what you want to do as well. So what I'm trying to do here is show you a lot of kind of 10 out of 10 setups. So this here, confluence of breakout, pulling back down, testing the prior base high, plus a 21-day EMA, shakeout demand tail to the 21, 1.79% versus a 20-day ADR percentage of 1.95. That is absolutely fine. Play it forward, okay? Now this can happen. It doesn't just explode. It doesn't just rip out and you're like, wow, I'm up 5-10% in the first day. Sometimes that's not going to happen. So you've got to just chill out. Remember, if you're swing trading on the daily chart, it's going to be a lot slower than if you are scalping and you're constantly looking for, this, shiny objects, bing, bing, like that. But I don't trade like that. How I trade is quite boring, quite slow. But it's deliberately done to be very methodical. Okay, I like methodical, slow, detailed trading. So here, you then get another shakeout demand tail. So this can happen, right? Shakeout demand tail. Now the position wouldn't have been stopped out here. That's another setup to be targeted. Another shakeout, and then the volume dries up. So you have a shakeout demand tail with the volume drying up to the 21, which is going to be one of the key moving averages. 10-day being the black line, 21-day being the blue line, 50-day being the purple line. Okay, that's where you're looking for these type of setups. Okay, so that would then be another setup in Eli Lilly. And then it starts going. So sometimes you have to have a little bit of patience, but that kind of pop, bit of testing action in there, and then the reversal. I don't know why I got that box. So pop, testing action, and then the reversal starts coming through. So sometimes you're going to have to be a little bit patient. Don't expect to be up 10% in the first day. It's unrealistic expectation. It's not going to serve you well. Now what I want to do is I want to go back and show you the historical examples, because you're just going to see, wow, nothing has changed. It's the same thing from 70 years ago, 100 years ago. Okay, go back, look at the Dow Jones chart on the weekly, and go back since the birth of the stock market, and just go back through. Go look at William O'Neill's books, How to Make Money in Stocks, and the charts that go back to the 1980s. It's the same patterns, it's the same candlesticks, it's the same moving averages. Now he has the weekly charts, so you'll be looking more so at the 50-day, which is a 10-week SMA closely aligned. So this one here, this is Coca-Cola back in 1964. Now I want to talk about something here that I didn't really talk about in the prior ones, which is the trend of the stock. So ideally, what are you looking for? You're looking for a stock that is in the context of an uptrend, right? Whether it be 2024 or 1963 and 1964, okay? It's exactly the same thing. We can see this continuation base forms here, okay? But what we'd like to see is a stock in a nice powerful uptrend and then find supportive action around the moving averages in regions. It doesn't have to bounce off it perfectly every single time, but here it's holding around the 10-day. Here it's holding around the 21. These little undercuts are fine, but nice uptrend that's holding around the moving averages is good. 52-week highs on the relative strength, pre-base, in the base, post-base are going to be really good things to be looking for. Now here is actually a little shakeout demand tail. And what do you notice about the volume? There's hardly any. And where does it happen? It happens at the base lows. So what is this bar telling you? There's hardly any supply. That's actually a really, really good setup there. If you were trading on the 21st of January 1964, which I doubt many of you were, me neither, right? But that is a really, really good setup, really good setup. And then what it does is it builds this kind of like base in here, a couple of contractions, there's another shakeout demand tail here, and then you get the shakeout demand tail here. The relative strength line actually turns up. So this is telling me, even though the stock's not really gone anywhere, the market's probably done that over a couple of sessions, whereas the stock's just held up really well. It's a little nuance there, but that's a really constructive sign to see. So again, it's targeting it through the high, stop just underneath the low. Now this will be split adjusted an absolute 1,000,001 times, but it's a pretty tight stop, right? 0.76% off an ADR at this time here. Coca-Cola slow stock 1%, still favorable. Okay, just over 2/3. And then it's just about doing the same thing. Now, if you've seen some of the other videos on the channel, you would have seen the bar by bar deliberate practice. So this is then what you do. You view your trading as a skill set and go, right, okay, I now know I'm looking for shakeout demand tails in the context of uptrends. Ideally, the relative strength line is hitting 52-week highs pre-base. Ideally, I see the volume drive. Ideally, I see the stock hold around certain key movement averages. I know specifically what I'm looking for. Great, I can now go and practice this as a skill set and look at improving certain aspects of my trading from an identification standpoint, from a controlling a risk, from a risk mitigation, from an optimizing profit standpoint. Okay, really, really important. Let me show you GATX. So this one here, right? Something happens for this stock. This is back in the 1970s. Something happens. Nice, powerful uptrend. So this is good to see, okay? Ideally, you would like to see a powerful uptrend, good volume coming through, persistently high volume is the best thing, like we saw on Broadcom. 52-week highs on the relative strength line, all excellent. Then we're looking as the stock base is to hold around moving averages. Doesn't have to hold to the penny, but here you can see, okay, holding around the 10-day, but the ADR is only 1%. The 10-day is probably going to be too quick for this stock. Okay, the 21 kind of tries to hold there and then it pulls back down in proximity to the 50. So this is actually an area where I like to target a stock in between the 21-day and the 50 after the stock has had a big rally. So this kind of region in here. Then what we're oftentimes doing as well is we're looking for evidence that demand steps back up pre-trigger bar. So you see this bar here, really strong reversal, and it does it on low volume. So this indicates there's an ease of movement to the upside. It's a widespread candlestick, opens on the low, closed on the high, and price easily moves to the upside on low volume. To me, that just indicates, well, there's easy movement. It didn't take much buying power to move this stock up. And then we get this shakeout demand tail. Now, this is buying it lower within the base, okay? If you think about this kind of zone here as the base, this is probably lower, just about in the lower third. Maybe it's getting into the middle third, okay? So something here... And again, if you view your trading as a skill set, you can then go and deliberately practice this. So when I'm targeting lower entries in the base, lower entries, lower pivots, whatever you want to call it, what I'm then trying to look to do is add if a higher entry forms. Now that is going to be in the form of a shakeout demand tail, a trigger bar, or a gap down reversal bar. Okay, now trigger bars, gap down reverse bars, I'm going to do specific videos like this in coming weeks on YouTube. But it's also taught in the blueprint video, which is already on the channel, right? So let's just play this one forward. Okay, gets out well. Okay, now watch. Now what chart pattern do you see? Cut, handle. Now you're going to learn about this in future videos. That is a trigger bar. I really, really, really like those bars. Okay, that is a trigger bar. So now what I can then do is look to add if I get subsequent setups form. So this is why I target 3 main candlesticks: shakeout demand tails, trigger bars, and gap down reversal bars, because they give you plenty of opportunities. Okay, plenty. There's no shortage of opportunities, I find. Okay, so shakeout demand tails, okay, trigger bars, you'll just start seeing these everywhere. Pull up charts, like pull up charts of whatever stock you want to look at: Apple, Google, Nvidia, AMD, Tesla, McDonald's, whatever it may be. Pull them up, go and study them. Like, go and study them. You'll see these things everywhere. You'll see them everywhere, okay? CTS as well. So again, concept here, what I can do here is touch upon something that's really important. So you see how the stock's rallying, okay? Rallies nicely, staying above the moving averages, generally starts basing and finding support of action around the moving averages. Now what happens here, and this is one of the strongest signs of strength you can possibly see, okay? You get 52-week highs pre-base, so this is the base. So it's happening pre-base over here, really good volume footprint as well, good buying coming through. And then you see this, 52-week highs in the base and a 52-week high on the shakeout demand tail. If you see a 52-week high on the shakeout demand tail, it's a ridiculous sign of strength. Because if you think about the market during this time, the market is probably doing this. Whereas the stock's just going, nah, I'm just going to hold up here. Someone somewhere for some reason is supporting the stock. Now you can't take out a clipboard with your questionnaire and go and ask every market operator participating in the stock, hey, why are you supporting CTS? Why are you supporting whatever stock it may be? ABC company, XYZ company. You can't do that, but visually you can see it. That's the thing, you can see it. There it is, there's the support. The market is weak, but yet the stock is holding up and hitting 52-week highs in the base. I'll say it again, 52-week highs in the base is one of the strongest signs of strength you can possibly see. So again, here, this is more of a hammer type candlestick, okay? Shakeout demand tail perfectly to the 21 and it closes on the high of the bar. The stock closes on the high of the bar is a very good sign of strength. Now, what's one of the things here? The initial stop loss is 4%. Now, that's going to be it's going to be just within 1.5 times the ADR percentage. So these are ones where you're pushing it a little bit, okay? You're going, okay, I'm about 1.5 times it. I'm still 4%. 4%'s okay. But then are there offsetting factors of strength to go, actually, this is a really good setup? Number one, the strength of the stock, how it's just trended and just held these moving averages wonderfully. The 52-week highs in the base are ridiculous good signs of strength, very strong signs of strength. The close of the candlestick, the respect for the moving averages, the stock, how it's been able to trend previously. Okay, this is probably one that we want to be targeting, right? So there you go. Then it starts moving up. So it's the same basis, it's the same setup. So what would you call this? Like a Davis box off the 21, shakeout demand tail 52. It's timeless. Honestly, it's the same thing. It just keeps happening. This is then KEX, okay? So very similar in terms of the setup, right? If I go to CTS, you can see it pulls up here, okay? It kind of bases in, KEX, and then we go KEX again. You see how it's respecting the moving averages? Like, it's just the same patterns, the same candlesticks, the same thing keeps on happening. You just have to really see it, really study it, really understand it. So this is KEX, 1979, okay? Now, something that you want to do, okay, is you want to look back at the stock and assess the character. Okay, so ideally you can see a stock, look, base in here from its IPO, base, really good trend. Little short base in there, really good trend. This is what you want to see, okay? You want to see a stock, the bases, trends. The bases, trends, and the trend is good relative to your selling rules. So how you're looking to optimize the profits. If you're looking for a stock where you want to go, right, I want to try and ride the 10-day and the 21-day, you want to look from the type of setup that you're currently targeting and go, okay, let me look back, study the previous character of the stock, and I can see examples of where this stock has broken out and it's trended really successfully and it's gone up X percentage on average over those last 5 breakouts. So then you can think about your risk relative to the potential reward that you think you can achieve for this stock. So if you look back at, say, 5 breakouts for KEX. Now what I'm going to try and do here is just make this 2.5%, right? Let's just, if we make this one wider, it's not going to do it. Imagine if this one here is 2.5%, okay? So with KEX here, the point is, if you look back and you go, wow, okay, over the last 5 years, 3 years, whatever it may be, I can see 5 breakouts for KEX that look very similar to this, where it's kind of basing 4-week base, 21-day, shakeout demand tail, 52-week highs, pre-base. Okay, nice, okay? Relative strength holds up pretty well in the base. You look back over the last 3-5 years and you're like, yeah, okay, I can see 5 breakouts from very similar bases like this, and actually the average percentage gain before the stock closed below, say it's 21-day EMA being the blue line, was 25%. So what you can do here is you can think not only about the risk that you're taking, let's say it's about 2.5% off the ADR of 2.75%, which is fine, it's acceptable. You can go, realistically, the character of the stock indicates it could run 25%. So therefore, my realistic reward is 10 to 1. I can achieve, if I'm going to use the 21 as a trading stock, I can achieve 25%, which in my maths is 10 times greater than 2.5% initial stop loss. So that's a really good metric. If you look at it and you're assessing your risk and you go, right, okay, I'm risking 1.5%, 2.5%, 3%, 4%, but I realistically think the stock could go up 3 times, 5 times, 10 times. Ideally, try and stay focused on opportunities that you think you could get 5 to 1, but ideally it's getting into like 10 to 1 category and above. Okay, if you only realistically think, if you're taking 2.5% initial risk on KEX and you look back, you study the character of the stock and you're like, I think it could go up 5%, that's 2 to 1. It's probably not worth doing, right? So KEX there, shakeout demand tail, low volume. Now just another thing here on KEX, okay? What I want to do is I just want to pull across this. So something that's really useful when you're looking at these shakeout demand tails is the context. Okay, you're looking for it in terms of a stock in a nice uptrend, is pulling back in, so the shakeout demand tail forms around 1 or more key moving averages. But if you get an undercut of recent lows, this could be last couple of days, could be last couple of weeks in this instance here. So the shakeout demand tail, as the name implies, shake out weak hands. Okay, if you were a trader and you were buying it, let's say in here, and maybe you bought this breakout, where's your stop loss going to be? I don't know, right there underneath those lows like that. So the low of this shakeout demand tail comes right down to that level. Oh, shake you out. But you have this shakeout demand tail undercutting the context of these lows. And what do you notice about the volume? There's not much volume. What does that tell you about supply and selling at these levels? There's not much of it. Is that a constructive sign? It's a very constructive sign indeed. So it's not just, okay, shakeout demand tail onto a key moving averages. Where does it happen in the context of the base and the recent lows? And then what you want to do as well is when you're building your process from an identification, controlling risk mitigation, optimizing profits, you then want to assess, okay, how do these stocks trend? What's going to be the way to optimize the profits? Is it riding 10 days, 21 days, 50 days, 200 days? Okay, go back, study thousands and thousands and thousands of them and build your process. I tell you what I do, build your process around that. What is your entry criteria? Like identification. What are you looking to do? How are you looking to control the risk? How are you looking to mitigate the risk? How are you looking to optimize the price? What are your selling guidelines? What are your selling rules that you're looking to use? Now, your selling guidelines is going to differ on a case-to-case basis, on a stock-to-stock basis, because different stocks move differently. So you want to assess. You want to go, okay, so this is KEX where we were looking at here. So there's then the uptrend that came through for it. But when I'm then looking at KEX here, okay, not that I was trading it in 1980, right? But it's the same point. When I'm looking here, I'm thinking this is an amazing. This is 10 out of 10. Right, this here, 10 out of 10 in terms of how the stock is basing, the supportive action it's finding around the 21. This here, look, another shakeout demand tail, little shakeout demand tail to the 21. No volume. Remember how it undercuts the last 2 weeks of lows, and there's no volume. Remember I was just telling you on the previous KEX example. There's hardly any supply. Same with this bar here, right? This is 9 out of 10, 10 out of 10 territory. And then what I'm doing is I'm assessing and going, right, okay, if I'm going to target KEX here, what do I think is realistic to expect for this stock? Well, when it kind of broke out from a similar base here, for it closed below, it's 21, it goes up 25%. Here, for it closed below, it's 21, it goes up 22%. Here, this was a really good trend, but it was from a much bigger base, but let's say there, 69%, but context is a bit different because this is a much bigger base. So I think the more appropriate ones are going to be these first two. Okay, these kind of first two in here for type of similar bases. So if we just took an average there, let's say it's 24%. Okay, something's 20, 23, 24%. So okay, if I realistically think I could achieve 24% before the stock closes below its 21 day, and if I was to do the 10 day looks a little bit more optimal actually for KEX. Okay, then we're getting to maybe like 29% territory. So if we were to go, okay, our plan on KEX series, we're going to use the 10 day and 21 days trailing stops. So we're going to look to free roll the trade, and then as trading stops, we're going to use the 10 day, 21 day, take an overall average 10 day on previous brace breakouts. If it's going to be successful, of course, 28, 29% sounds reasonable. With the 21 day, could be around 20, 24%. Okay, 21 day is it's not going to be quite as optimal it looks like for this. So then what we can do is we can assess our risk. So again, initial stop loss about 3.5% off an ADR of 3.5%. That's fine. Nice setup. Okay, does the stock trend well subject to these selling rules we're thinking about using? Check. Yes, it does. Okay, so if we then just play this forward. Okay, let's play it forward here. Sometimes you can then have the best laid plan and it doesn't go on that big trend. So this is then where you have to adapt to the market and you go, wow, I think this is a ridiculously good setup. Then it starts violating my rules, but it didn't achieve 25%. And sometimes that will happen. And you just have to rock and roll with it. You have to kind of take the punches and go, okay, best laid plans and all that. Okay. Sometimes it doesn't work. Sometimes you're not going to get that kind of 25% move that you're intending, but you still just follow your selling rules, selling guidelines anyway. And then if the stock resets, then you can look at targeting it back again. McDonald's, this one here, this is in February of 1981. Okay, so again, McDonald's here looks to me like it's trying to build a pretty sizable base here, and then you get a change of character. Okay, you get very strong rally on persistently high volume. Something has happened here. Okay, there's a lot of buying interest for whatever reason. Okay, what's more important than the why is it is. We can visually see it, and then you start to get this base forming. So you get this shakeout demand tail, and look at the volume. What do you notice about the volume? There's hardly any. What does that tell you about supply? There's hardly any. Now in this instance here, the initial stop loss is about 1.2% versus a 20-day ADR at this time 2.1%. That is very, very favorable indeed. It's nearly half. Okay, so that there is going to be really, really nice. But you see what I mean? Maybe the breakout point, I don't know, I don't buy it there, okay, unless it kind of sets up kind of perfectly underneath, trigger bar, shakeout demand tail, gap down, reverse bar just underneath the base high. But I'm not buying up here. Okay, I'm not just looking to kind of randomly buy it through that. I don't want it like I'm not the trader that's just buying here because it's moving through kind of a price. That's not me. Okay, I'm not doing that. Okay, I'm pinpointing my entries that are often much lower within bases. Okay, I'm very rarely buying that up there. Okay, but it's the same point here. Okay, thinking about the initial risk versus the 20-day ADR pop testing action. Maybe there'll be an ad spot, maybe there won't be an ad spot. You then really want to assess how do these stocks move, and again, that kind of pop, test, back down to kind of these levels in here. So the previous ceiling becomes the floor. So this is where prior resistance and acts as support. So again, pop, test, reversal kind of framework. This is then the reversal. That's when I'd be moving the stop loss up. Again, we do that in kind of the bar by bar videos on the channel. Let me show you a couple more, okay? So this one hit, this is SLM. So this stock here actually hits 52-week highs in the base. Now this is a really encouraging sign to see. You see this volume here, and you see the candlesticks. Certainly the first one, bullish synchronicity. Widespread candlestick indicates demand. Opens on the low of the bar, closes strong on the bar, and then you get this kind of cup and a handle forming here. Look how the volume dries up in the handle. So generally, tightness in price, low relative volume indicates there's little supply coming to the market. We would also want to assess the character of the stock, right? So this is kind of the breakout here. Okay, trend's okay. This one here, really good trend for this stock here. You can see close below the 10-day there, close below the 21-day there, close below the 50 would actually be here. Okay, interesting. Maybe we want to keep some back for the 50. Here's kind of a breakout here, breakout here. So you're assessing what moving average do you think are going to be best? Is it 10-day? Is it 21-day? Is it the 50-day? Okay, for me, it's probably never going to be the 200. It's going to be very, very slow unless I really want to kind of campaign a position. But for me, invariably, it's going to be 10-day, 21-day, potentially the 50-day. So this is where you're planning the trade out and thinking, okay, if I'm going to optimize the profits, both in terms of monetary gain, but the efficiency of the gain, what do I think are going to be the best moving averages? And oftentimes it's a combination of those to help guide my selling rules, okay? My selling guidelines. Is it 10 days? Is it 21-day? Is it part for the 10, part for the 21? Maybe keep a little bit back for the 50 as well. And then again, you want to be going here and you want to be going, right, before that closed below, okay, 13% here for it closed below, around about 8%. This was a much better trend in here. Okay, 14%. This one here, it kind of broke out from this low pivot, only around about 6-7%. So, okay, this is where you're then going, right, if we just took an average of those, let's say, what's that going to be? Around about 8, let's say it's 8-ish% or something like that. And what you could do here is you could go best case scenario. So you can take average and then you can take best case scenario back 14% from the evidence that we have for the stock. So we're basing what we think is realistic on the stock's own character. Okay, we're not looking at CNBC financial media, okay, for this stock, the price target is, right, we're not doing that. Okay, what we're doing is we're assessing it and going, okay, let's apply some common sense here. When this stock breaks out from a base like this, if it's going to be successful and trend higher, all things being equal, we could expect 8%, 9%. Best case scenario, maybe about 14-15%. So then what we do is we assess the initial risk relative to what we think we could achieve. Now, in this instance here, about a 1.5% stop to realistically achieve maybe something around 8%. Well, maybe we want to do it, maybe we don't want to do it. So around about, the reward is about 4 times greater than the initial risk, a little bit higher, maybe about 5. You see what I mean? It's right on the borderline there. So this is sometimes where you could have a really constructive setup, but you go back and you study the character of stock and go, I don't know, it's marginal. This one, right? So this is where sometimes you can have a really good setup. So on the face of it, you're looking at this and you probably went, that's a really good setup, isn't it? That's like 9 out of 10. But again, what feeds into that 9 out of 10 is actually, what do we think we could realistically achieve based on the initial risk that we are also taking? That's a very important consideration in terms of them ranking the setup. You're not just looking at the base. You're looking at things pre-base as well and trying to get a feel. Because if our initial stop loss is say 1.5%, but we actually think, wow, we go and look and we look back in the last 5 breakouts, actually the average gain is like 30%. Now that could be a 10 out of 10 setup. So imagine if these here were not 13%, right? Let me just do some extreme example, right? Imagine here, if we were looking at these and we were like, well, actually the prior breakouts have been 54%, 41%, 46%, and our initial stop loss could be 1.4%. Now that is now looking like 10 out of 10. Now it's not, stay with me here, okay, but you understand the point. Then when you're assessing the risk to the potential reward that you realistically think you could achieve based on the character of the stock, now there's a massive skew. This is asymmetric in nature. So identify, control. The controlling is where you're trying to create asymmetric risk versus rewards. You are trying to risk 1.4% to make 40%. That's ideal, okay? But same kind of concept there from a supply and demand perspective. Then a bit of pop, testing action. Here you actually get a trigger bar, low volume, 52-week high in the base. Really good setup. Now this one here is Pantheon Resources, okay? So sometimes something can kind of materially change in the stock. Now you could be looking at this as well and assessing kind of the character of the stock and go, wow, this stock is quite volatile. Okay, this does not move like a Google or an Apple or an Amazon or a Microsoft. It doesn't move like that, right? This is very aggressive. Very aggressive, very aggressive. So know thy stock. Know what type of stock you're trading. This stock here bases really nicely. Here tightens around the 10 and 20. Look how the volume dries up. It's aggressive stock. Okay. Now this is why selling rules and selling guidelines are important, because you don't want to be the trader that buys it here, has a nice gain on it. You should exit there on the change of character. You should exit there on a close below 50, and then you just hold it all the way down here. And you don't want to be that guy. Don't be that trader, okay? But here, what do we see? We see 52-week highs. We see high relative volume coming through. Bullish synchronicity. There's a synchronicity between the price action being a widespread candlestick that opens on the low, closes strong, volume confirming the move, 52-week high, exceptional. Now the stock starts basing, find supportive action on what moving average? The 21, pop, higher low into the 21, tightness. Look how the volume dries up. It's really, really, really good sign. Really good sign. Now remember, this is lower in the base. It's lower in the base, okay? So that's the entry there, okay? The entry is there. Let me just mark these for you, okay? So this is going to be the entry. Now, I'm not going to go through the free rolling and stuff like that because I think this video will become very long very quickly. But there's the entry in there. Okay, pop. And then what are we looking for? Testing action. There's another shakeout demand tap. There's another entry point right there. Look how the volume drives up, 52-week high. And then what you're trying to do is when you really break it and you try and understand, okay, the character of stocks. How do stocks move from point A to point B? What do the leading stocks do? What are the leading TML type stocks? That's your O'Neill stocks. Big earnings, big sales, big estimates, global product, institutional sponsorship, new technology, exciting things going on, okay? That's your TML type stock. Then you're going to have your momentum leader type stocks that have high 20-day ADR percentages, so above 5-6% say, and they have high 50-day average dollar volume as well. They're very liquid, okay? Like a day trader's paradise, basically, okay? They're high moving stocks, they're very liquid stocks, so kind of day traders and scalpers can get in and out of them as well. But the character of the stocks, you'll see some stocks character is that they are momentum leaders, such as like an Affirm is a momentum leader when it wants to be. High ADR, very liquid stock, 30-day average volume is 23 million shares on a $44 stock, and the ADR is over 8%. And the 52-week highs on the relative strength line. That's a momentum leader type stock. Now your Nvidias, your Apples, your Microsofts, and the Googles, they're not going to be that. Okay, that's not them. That's not their character. Now you can't change that. You just have to accept that. But understand the type of stock you're trading. Are you trading a TML? Are you trading a momentum leader? Are you trading a group theme leader? So it might be at this point here, I think Pantheon Resources from memory is an oil and gas stock. It might be that oil and gas stocks are very, very strong. You're seeing a lot of relative strength in the group. So here you could be going, well, it's not really a momentum leader because it doesn't quite have the liquidity, or maybe you think it does have the liquidity. It has the ADR percentage, but it's a group theme leader. It's one of the leading stocks in, say, oil and gas or whatever it may be. This is a UK stock. Okay, but then what you're trying to do, okay, if we then play this forward, trades like this, you get some trigger bars coming through in there. Okay, play there. Okay, you start to get the change of characters, right? You see that? You see the change of characters. So this is the Livermore point, right? Stocks will give you a tip off of when to get in. They'll give you a tip off of when to get out. So you're trying to dial in your pattern recognition and, again, mental frameworks, mental representations. Train yourself to what you are looking for and understand why you're looking for it. Okay, when I say bullish synchronicity, why am I saying bullish synchronicity? I'm looking for a lot of buying. And that's just how I link the concept in my head. I'm looking for a lot of buying. This is really, really key. This is important. Then I'm looking for a stock to do certain things in the base, whether that be the RS line, the candlesticks, the respect, holding around certain key moving averages. What I'm then looking for in terms of the controlling of risk, okay? Then what I'm trying to do is I'm trying to ride trends like this. Now, do you get these every single day of the week? You don't get them every single day of the week. But you want to maximize these, you want to optimize these when you do get them. Now, this is the variance lady luck in the market. You don't know this is going to happen ahead of time. You have to find out. Okay? When you're buying the stock, you don't know whether this could go up 50 times your initial risk. But you're going to find out. And that's the point about having selling guidelines to help guide you and go, right, what I'm going to do here is this stock here is very aggressive. So what I actually think is 10-day, 21-day is going to be fairly good for this stock. When it broke out here and closed below its 21-day, goes up around about 85%. That's really good. So if our initial risk is 3-4% and we're going, well, we can actually see evidence of a time it went up 85%. Now that may be best case scenario. Here, what did it go up? Okay, 24%. Here, what did it go up? 30%. Okay, so you're assessing the character of the stock and you're kind of working out best case as well. You're like, well, if this stock is really going to kind of rock and roll, 85% is not is not kind of unrealistic, right? Because we've seen it. It's there, right? You can go back and you look at it, 2012 when the stock did that. Okay, interesting. So if I'm going in with 4% stock, best case scenario, maybe 85%. Now, maybe the stock can surprise you to the upside. So if you're then looking to ride key moving averages, the first close below the 10-day, which is really the 10 and the 21, is up here. The stock goes up 338%. Now, how many trades are you going to have like that a year? Don't. How many trades are you going to be able to stay in that do that? That's another question, okay? You may be able to get in a trade that then does go up 338%, but are you going to manage it correctly? That's then another question. Are you going to be able to manage it correctly? Do you have the emotional control? Do you have the skill set to do that? That's then another question, another matter. So again, if you view your trading as a skill set, okay, yes, you may have been able to identify that, but did you optimize it? These handful of really big trades that come around every year, did you optimize it or did you not? Did you mess it up? If you did mess it up, why did you mess it up? What did you do when you did it? Where did you do it? Why did you do it? Okay, everything is very kind of systems based. It shouldn't be random. You shouldn't be randomly doing things and go, it shouldn't be like that. You should know what it is you're doing, why you're doing it, and when you are doing it, because then you can go back and you can improve upon your decision making. Inputs, outputs, input, output. What are the inputs that you're putting into your trading? From an identification standpoint, controlling risk, risk mitigation, optimizing profits. What are the inputs? What are you doing? When you then change the inputs, realize that if you change from a systems level the inputs, you're going to get different outputs. Do you like the outputs? Do you not like the outputs? If you don't like the outputs, go change the inputs. And then we're going to finish with one final one, which is NVIDIA. And I just want to make the point here. Again, the kind of psychology. So NVIDIA, a TML type stock, right? So big earnings, big sales, big estimates involved in new revolutionary technology in 2020 kind of artificial intelligence, right? So 52-week highs coming through, nice. And then what do we see here? Oh, nice shakeout demand tail off the 21. Risk probably didn't make sense there. But then the stock starts basing. It's kind of like a big Davos box in here, right? Now it pulls down to the 21-day EMA, puts in a shakeout demand tail. Now you see how I've extended this red line, okay? Undercuts the last week and a half of trading. And what do you notice about the volume? There's not much. Oh, and there's 52-week highs. Interesting. Initial risk 3.32% off an ADR of 3.45%. Absolutely fine. Okay, absolutely fine. And then we're trying to optimize the profits. Okay, we're then trying to optimize the profits. We're using selling rules, we're using selling guidelines. But that there, really nice shakeout demand tail. So I really hope you guys have enjoyed that video. If you made it all the way to the end, there's now a 153-page slide deck available to members on my platform, along with what will be in the next couple of weeks, trigger bars and gap down reversal bars to accompany the blueprint PDF there as well, because I really want to give you more detail in terms of these shakeout demand tails and just show you they are timeless. You can look back at charts from the 1910s to 2024. It's the same thing. You will see the same type of setups, the same type of characteristics in the base. Leading stocks act in a leading way. They have done it since the birth of the stock market, and my belief is they will continue to do it. So thank you very much for watching this video. I really do appreciate all the support on the channel, certainly if you made it all the way to the end, because you guys are the guys that really support the channel. So thank you very much indeed. It is greatly appreciated. Any questions, just ask me in the comments below and I will get back to you as soon as I can.